The really troubling thing, though, is the labor market, which I mentioned at the outset. I mentioned that unemployment's at 10.2% right now, which is the highest unemployment rate we've seen since the early 1980s. That's true in most jurisdictions. There are some metro areas in the country where it's highest on record. Here, the unemployment rate, both in Chester County and in the greater Philadelphia area, it's similar to the U.S. unemployment rate. It's much lower than the U.S. unemployment rate, but it's the highest this area has seen since the early 80s. It's not a record high, but it's the highest it's been in almost 30 years. If you look at the monthly job numbers that come out every month by the Bureau of Labor Statistics, this top line number, they always say, you know, jobs fell by 180,000 last month and unemployment was 10.2%. That is a net change that they're reporting. So you take all the jobs that were created and you subtract all the jobs that were lost and you get a net figure. We're still in the negatives. But what it doesn't tell you is sort of the composition of that. Is it that we're losing less jobs, or is it that we're gaining more? Or maybe we're not gaining more, but we're losing less. This data up here, it comes from another survey by BLS. It's called the Job Openings and Labor Turnover Survey. This survey actually breaks that down on a quarterly basis. So what we know by looking at this and some other labor market indicators is that almost all of the improvement in the labor market since the spring, when it was at its worst, has been because layoffs are abating, not because employers are hiring. In fact, only very recently, and if you look at the dark blue line on the right-hand scale, are we seeing any real uptick in hiring? And even that has been really small. And if you look at the rate of hiring, the number of hires, I mean, it's still down. This data only goes back to 2001, but it's lower than it's ever been. So we're seeing less people laid off, but we're not seeing anybody being hired, which is why we have this persistently high and rising unemployment rate. So, I mean, it's great that fewer people are losing their jobs, but if all those people just are added to the ranks of the unemployed and there's no job creation going on, you can imagine how this is adding up to a really bad situation. We have people exhausting unemployment insurance benefits at a record rate. So there are many people that are running out of benefits and they've already been unemployed for, say 6 months right now. Actually, the median duration of unemployment is 6 months, which is an all-time high. Unemployment, that you may know that the Congress and the President just signed another extension of unemployment insurance into law, gives most people an additional 26 weeks of unemployment insurance if they've already exhausted all of the state benefits and the federal emergency benefits. But this has really big consequences for the labor market, particularly for consumers and retailing and income and wage growth. You know, once the economy does start to recover and people start adding jobs again, they're going to have their pick of the litter. There's so many unemployed people that real wages are falling because there's just no negotiating power for wages right now because unemployment is so high. So this is the main risk to the recovery right now, is that if we don't start seeing some consistent job creation, then this may be drug out longer and longer. And you may have heard the term jobless recovery thrown around, and this is sort of shaping up to be your quintessential jobless recovery. We had one after the recession of 2001. The recession of 2001 officially ended in November of 2001, but we didn't get net job growth until almost 2 years later, the end of 2003. This is turning out to look like that. We know that the recession is probably officially over, but we're not expecting any net job growth until probably the second half of next year, probably around the third quarter of next year. Then to complicate situations, we have housing crises still going on in many parts of the country. Now, I mentioned that this first-time homebuyer tax credit has really helped juice up sales recently in the past few quarters. That's true, and it was just extended and expanded by Congress. So they've extended it through the end of April next year, and they've also expanded it to give credit to people other than first-time homebuyers. So even people that already have previously owned a home, they're looking to buy another home. You can get a $6,500 tax credit for that. they're trying to juice up the middle of the market because pretty much all of the strength recently in home sales in many localities has really been at the low end of the market, people taking advantage of the tax credit. Right now, there are mounting foreclosures. It's not yet peaked, we don't think. This chart shows you the number of first mortgages that are in an early stage of foreclosure or approaching an early stage of foreclosure. So you have mortgages that are 90 or more days delinquent. You have the green part of the bar is notice of default. So this is more than 120 days delinquent on the mortgage. And then auction and REO. REO is real estate owned. This is when the bank actually buys back a home in an auction that's gone into foreclosure. So you have this number rising. And it kind of took a breather at the beginning of the year because a lot of cities and counties enacted foreclosure moratoriums where they said, okay, we're not going to allow banks to foreclose on homes for a few months. That sort of allowed people maybe to catch up a little bit with their payments, but a lot of that has ended. And so now we're seeing, really it just delayed the inevitable in a lot of cases. Now we're seeing a lot of those foreclosed homes come on the market. Now, of course, real estate, right, is local. So this is not true of everywhere. The major housing oversupply situation is concentrated in California and Florida, Nevada, Arizona still. Sort of related to the housing market is the credit markets, which I mentioned are still much better than they were, say, last fall at the height of the financial crisis. But you still don't have the capital markets and the debt markets operating the way they were, and it's uncertain if they really ever will, if a lot of these products will ever come back, at least in the form that they were first being traded in. These are various types of securitized assets. So we have CDOs, collateralized debt obligations, asset-backed securities, commercial mortgage-backed securities, and residential mortgage-backed securities. So the RMBS, the residential mortgage-backed securities, this is sort of what juiced up a lot of the speculation and really led in large part to the financial shock that happened last fall. This was a lot of the subprime mortgages that were pooled and packaged and traded. They were given by my employer, Moody's, and some other credit rating agencies, very good ratings when they turned out to not, they actually turned out to be junk in reality. They were very poor quality. So we're seeing that market has pretty much disappeared. The only part of it, you can see the 09 year to date, is this asset-backed debt. There's been some issuance. That's mostly been because of the Federal Reserve buying up asset-backed debt under one of its programs where it's buying securitized debt on things like auto loans and student loans, credit card loans. It's also buying Fannie and Freddie debt, which has helped to keep mortgage interest rates low. The Fed has said, I guess more than hinted, said that they're probably going to stop doing this early next year. We'll see if that actually happens. I think it depends on how the economy plays out over the next quarter. Certainly if the housing market is showing real signs of improvement. But we still don't have all of this issuance that was going on, and this is part of the reason why credit is still very, very tight. If you look at various surveys from the Federal Reserve, one is called the Senior Loan Officer Opinion Survey, and it asks loan officers at all the Fed-regulated banks, how is demand for various types of loans, and are you tightening standards, are you loosening standards? And still, on almost every single type of loan, banks are saying they're tightening standards on loans. So it's much harder to get a mortgage. You have to have much better credit than you did a couple of years ago, which is, admittedly probably a good thing. But what it means is that we're not seeing a whole lot of credit flowing through the market. Even to small businesses, we're not seeing a lot of commercial and industrial loans being made. Demand seems to be weakening, but also the supply of loans is down quite a bit.